All right, everyone. Welcome to the March 14th Trade Findings and Adjustments. If you can hear me, please drop me a little note there in the chat so that I'm sure I'm being heard. We have a few people still coming on. All right, guys. While you're kind of filtering in here, let me introduce myself. My name is Keve Bybee. I'm a registered investment advisor with Hurley Investments. I work with Kevin. He couldn't be on today, so he asked me to get on and go over some things with you that we have been talking about and give you some thoughts and ideas. Last week, or yes, last webinar, Kevin went over some of the ways that an option can move, and we discovered 9 ways in that it can go backwards, forwards and up, forwards and down. It can go up, it can go down. You can bring it back in time and up in price and strike, or back in time and down and strike. All those, including leaving it alone, leave you with 9 different ways you can move. What I kind of want to go over is something similar, and that's the principle of options give us options. What do we mean? Well, to answer that, let's talk about some of the weaknesses of options. Can anyone tell me, you could come up with plenty of answers, but just give me an idea what you think some of the biggest weaknesses of options are. Give you just a second. What are some of the biggest weaknesses of our options? All right, so not seeing a whole lot of answers coming in, but let me just give you an idea. And that is time value. Let me write in the question. time value, meaning options last for a certain amount of time. Unlike stock that lasts forever. But what do we get with options? What are some advantages? And I'll leave that with you for a question. What are some advantages of using options? Okay, I got one. Let's see, what's a good way to explain this? Yes, you're right. Lance, they are leveraged, meaning that one contract works for 100 shares, represents 100 shares of the underlying stock. Okay. Anyone else? Any other thoughts? One I like is for long options, your risk is defined. Can't lose more than what you paid. And that way, it's not kind of, it is a hedge for a long call. Let's make as an example, the long call is a hedge to stock ownership. Meaning, I don't have to go out and buy 100 shares of stock, but where $100 stock would be, room here, stock would be $10,000, where a long call would be for that, depending on how long, obviously. But let's say a $10, $100 stock for about a month would probably cost around $2 to $3 per share. So you pay $300 to control 100 shares instead of 10,000. So, listing some of those, what I wanted to go over as well is, since options give us options, we've talked a bit about, I know Kevin has gone over full call spread, some other ones we talked about, why don't we do some bearer put spreads? Why don't we do some bearish trades? Think out of the box. Obviously, that's all good, and I think what's important is learning how to manage risk and what the potential risks are in our current market. So, what am I getting at? Well, just thinking about the last year, we had in 2018 several different sell-offs, and last year was kind of a crazy year, to be honest. And we had Ray Dalio come out at the beginning of January in 2018 at the situation where we had tax breaks coming in, and the expectation was that the stock market was going to just keep going up out of the stratosphere, and everything was looking great. And we had a 6% up January, not as good as our 7.5 or so this January, but it's a completely different situation. But for 1 month, that was kind of crazy. It was going up. We were up 6%. Ray Dalio, who is a hedge fund manager and very successful one, he came out and said, if you have money on the sidelines right now, you're going to feel pretty stupid. If you're holding cash, if you have money, let's see, how did he say it? Cash sidelines, you're gonna feel pretty stupid. Not gonna. All right. What happened? January 2018. You're gonna feel pretty stupid. That's what he said. You don't have your money in the market, and it was obviously I'm paraphrasing, but that's pretty close. Then in February, fifth, sixth, I'll say the 5th. Market crashed by, I think it went down almost 13%. Then what did he say? Around, I want to say August. You should be looking at, he said something like, you should be looking at protecting, that's not what he said. I'm trying to think. He said something to the effect of to be conservative and cautious with your portfolio right now. So kind of completely opposite. Like that. Kind of completely opposite. Those aren't his exact words, obviously, but it was something to that effect where he was saying, you should kind of pare back your expectations of the market going up higher. And this was a time where I think it was actually more like September, I want to say. Where it was kind of up to its highs of the year and had come back a little bit, or kind of stalled. Obviously, there's a change in his rhetoric, and I thought that was pretty funny and kind of interesting because it showed that even the best of the best and the most successful in this market, in the stock market, can get it wrong and can make mistakes. And yes, I thought that was pretty funny that he came back and kind of walked back his earlier comments in the year right before a market flash crash. But I guess what I'm saying is, since even the best can get it wrong, it's important to know that it's okay to guess wrong. So it's important to know that it's okay to guess wrong, but as we're learning how to manage risk, what the potential risks are in our current market, some things that we can do to help ourselves out by using our brains. Talk to a mentor, Kevin or myself. Talking through things is and I'll say bouncing ideas is invaluable. I like to think that we're kind of trying to help you see what the potential risks are. And I'll tell you right now, potential risks of this market is, in fact, I'll let you, before I answer, I want to hear from you. What are the potential risks that we have? What have been some of the reasons that's caused our market to be a little crazy? What's caused it to sell off from last year? I have one answer which is what I was going for. I'll say I'll add potential trade war with China. That's not how you spell it. Yes. So that's obviously what's on everybody's mind right now. This year, there has been a few. Just go to the chart here. There's been a few small pullbacks. Right here, a little bit, right there. Struggling to get over the 200-day, this red line here. And just last week, another test of the 200. Now we're up at this level of resistance. Right here. Pretty much where we're at today, but it looks like even we're starting to build a base here, at least over a couple of days. So, sorry, getting sidetracked. Believe this was the jobs report. Can't remember what this one was. I apologize. A few of these other ones were still just, I believe this one especially was uncertainty of news coming out of the China-U.S. trade agreement, where it kind of keeps getting pushed back. The meeting with Trump and Chinese President Xi overall has continued to go up pretty good for this year. Huge bounce back up from last year's sell-off. So yes, that is one of our big question marks, is potential trade war with China. And I'll say, oops. I gotta get my pointer back. There we go. Or, well, I'll just leave it at that. Because a trade resolution, I was going to say, would be good news, and that is one of the things that's really going to push our market up. So, I guess, why am I saying this? I just kind of want those things, that to be on the back of everyone's mind and something to look out for. It all boils down to, I mean, obviously there's a couple other things that caused some of the sell-offs, but certainly last February, 2018, it was more of a 2 and 10 year yield on the bonds that triggered a algorithmic sell-off, and certainly that, as it happened a couple times last year, is a concern. But we're not as much right now, with the Fed coming out and being more conservative and saying that they're going to be easy on raising the interest rates. But it's all just uncertainty. All right, so talking through things, how we use our brains, how we understand and know the current risks. What I mean is, I want to go back up here. Options give us options. Options allow us to guess wrong. or I should say, if you set it up right, let's say it this way. If you pay attention to potential risks, options give us the ability to guess wrong. I'm really just talking about hedging your bet when we talk about a bull call. I'll erase these. Bull call. We have a long call that's capped by a short. Short call is the hedging option. So if it goes down, we lose. Just say if it goes down, I'll say if the underlying stock goes down, we lessen our cost basis thanks to the short call. So in that case, the short call gives us the opportunity to guess wrong. It lessens our cost basis. It does cap our upside potential. But again, we want the ability to guess wrong. Or if we don't make the right trade or the right time, we don't place the trade at the right time, it's okay. We're gonna survive to go another day. And I was gonna highlight this. Okay, and I will go this. Long call. You can do the same. You can think the same way with bear puts and long puts, but for the interest of time and just explanation, we're going to go over just the calls. So long call. What if we're only doing a long call? Well, as we discussed earlier, our time value is one of our uncertainties with options. So how do we allow ourselves the ability to guess wrong? We go far out in time so that if things go the wrong way, it has time to come back. And we can still lessen our cost basis by doing what? By buying more contracts a much lower price. If it so, go far out in time, at least talking about leap long calls, or at least you can go 6 months, but we're really talking more like a year. Okay, so I've gone over some things. I hope that gives you some ideas of how you can look at risk. And obviously we have market risk is kind of what I more went over, but we have the individual stocks and that kind of thing. Are there any ideas or questions on trade ideas that Kevin had gone over last time or that you're looking at? And while you're thinking of that, I'd also like to kind of show you what positions Kevin had on this week. Put on a bull call on Boeing and also added long calls for Visa. These are leap long calls, January 2021, 160 strike. So, Boeing, what was going through Kevin's mind? I didn't talk with him a ton about it, but if you've paid attention to any news, you know that Boeing has had a huge pullback from way up at 445-ish all the way down to 376. A nice, very nice sell-off. Just looking at it technically from a chart. Look at this. Right down to a big level of support. Right here, right here, right here, here. Of course, back here it was a level of resistance because it was having a tough time getting over this price, the around 160, 170. So pulled back. Kevin has on a 385 long call against a 390 short call. Just to go through some math, let me bring my thing over here. Boeing. Cost basis of on the long call. I'll say long call at name what it is, 385 long calls. Obviously he has 3 contracts, but just going over on a one contract basis what the cost is. And he paid $13.55. And sold a 390 strike And a short call for 11.54. Just do some math here. We go 11.54 minus 15.5. 2 1 cent. $2 cent. Cost basis. And that you can see here, $1.01 difference in price here between these two. Sorry, I'm struggling with the highlighters this morning. Risk $2 to make 5. Well, I should say 5 minus $2. I'll just say 2 because 1 cent's kind of silly. Equals $3 of potential profit. Right now, net gain 97.50, just up a few cents. But what we're really looking for, see if we get a big jump as it goes back up. Hitting the support level. Just if you know a little bit of news from it, Boeing had some issues with a couple airplanes, one in Ethiopia, and I'm trying to think of somewhere else. I can't remember what the other one was, but there was 2 crashes that they linked to possible problems with the Boeing's new 737 MAX, and they're still kind of investigating it, but obviously that's the reason behind the big sell-off. And you know, new planes coming out, typically things happen. I kind of hearing that it's from Ethiopia, it was the problem of a crash, kind of makes me, I don't know, kind of makes me wonder whether there was some pilot error in there. Just makes me wonder, and maybe that's kind of where Kevin was going with that, but kind of an interesting thought. I do think there could be, this is a good opportunity for a bounce back up, and we're out to April 26 options. I'll make a note of that. Here we go again with my highlighter. Hasn't changed so much where if you've gotten into this one, it wouldn't wouldn't be a bad one. He has a sell limit for $2.42 to make a good chunk of change. Obviously, that wouldn't be a terrible idea to follow along there. For a 41 cent. Profit. $0.41 times 300, or 23. Alrighty. So hedging option here with the short gives us a chance to guess wrong if it goes down the other way. It doesn't hold that support level. The other one I wanted to talk about was a Visa long call that was put on. Two contracts, January all the way out to January 21. Goes back to what I was talking about for our long calls. What is our hedging thing that's going to give us a chance to guess wrong? It's time in this case. Again, one of the biggest weaknesses is time value in our options. If you go too short, you may not have time to let things come back if it falls. Just to look at Visa. And Visa, what's kind of crazy, is a stock that is making all kinds of money and just has gotten swung around with the market and topped out at 150 here last September before this big sell-off. We both had positions of long calls, leap long calls for Visa, way back here at 125. They looked fantastic up at 150. Of course, not so good as they came back all the way to 122. But what was cool was because we did have some time, and these were 125s out to January 2020, I believe. I'm trying to remember right. We were able to dollar cost average, where when things fell, somewhere around here, we were able to buy more contracts, lowering our cost basis, so that in the event that it got back up, we were even more profitable. Of course, it went back down. Somewhere in here, we added a couple more. For some folks, and man, did that look fantastic. Some others that obviously, well, let me go back. We had cashed those in, our 125s, strike Visa long calls for a wonderful profit. Hold back a little bit right here, down to 145. And what we're looking at and why we added some back on is it looks like Visa finally is breaking this resistance level of 150, up at 154 today. And expectation being that we can go having captured our profit, but even if you're just getting into a position or looking to get into this position, which is still a good idea, is getting back on for us was 160, which costs $17.97. Some people it was less, depending on my clients that I got back into this for. But cost basis of $17.97, that's $1,797 for one contract. Visa long leap, long calls out to. So recommendation right now, if you're looking to put a trade on Visa, looks fantastic. Yes, it's always kind of a pain to, obviously, I wouldn't say a pain, but obviously it would have been better to get in down here, anywhere at the beginning of the year, any one of the pullbacks, anytime last year. Of course, that's not the situation we're in right this second. We're looking at the future. January 2021, 160 strike. So what does that do? That gives us time where Visa pulls back. Again, we can dollar cost average by, scoot this over, buying more contracts at a lower price. So let's say Visa goes up for a bit and then just comes back down all the way down to tests 140-ish. Obviously, I would say that's going to be your next best support level. Maybe make a case for 145. But in any event, and of course, depending on why it pulled back, and obviously we deal with that and go over that in the future. But just to give you an idea, if it pulled back something like that, the Visa long calls, same contracts out to January 2021, 160s are going to be much cheaper, probably closer to $12 at that point, maybe even a little less. And that if you double up, we have two contracts here. If you bought two more at that price, that lowers your cost basis so that when it does get back up to 154, 155, you're more than profitable. You have more profit in the trade, and you can even get out sooner. So when it gets back up, you have more profit and lower your break even cost. All right. Sorry for babbling on so long. Are there any questions? I know I've kind of just gone off on my own, but if there's any questions on any of these, I didn't see any questions come in or comments for trades or things that you guys were looking at. But are there any questions with some of these potential trades that you could put on today? And look to make some money with. I think it seems to me that's pretty straightforward, but obviously, obviously I'm not you, and I know that I can explain things in a way that that makes sense to you, that makes sense to me. I'm still not seeing anything, so hopefully that's a good thing. I think that's really all we had for today. Just waiting to make sure there's no other ideas or questions. But if that's it, guys, I really appreciate you attending this trade findings and adjustments today. I hope this has kind of given you some things to think about that are beneficial. And thanks for letting me babble on about the stock market. And just get this here. Oh, it's not letting me put it in. I'll attach the screenshot I did of the Visa chart. Obviously, you can go look at it yourself if you'd like. Stock charts. All right. I think that's it for me, guys. Thanks again, and I hope to be on here again another time and hear from you again. We will see you then. Take care.